So let's begin. Welcome everyone. I'm Andres Fernandez, and thank you very much for accompanying us in this invited session entitled Fiscal Policy in Trying Times. This session was organized by Charlie Beck, who unfortunately cannot be with us today due to some minor health issue. Luckily, nothing serious. I'll be substituting for him. So I'm also glad to chair the session. We'll have 4 great papers in the following order by Joshua Eisenman, then Guillermo Calvo, Klaus, and I'll be presenting the paper that Carlos was going to present in the end. So the rules are quite simple. We're going to have 15-minute presentations so that to fill out the 1-hour slot. Now I'm being told that in the end we could have some discussion for those of you who want to hang out after that. I myself can stay for some 20-30 minutes. So hopefully you stay. Thanks again, and let's begin. I'll inform you guys when you have 5 and 1 minute left. Okay. So Joshua, can you
Sure.
start sharing?
Yeah. So hopefully all of you can see the full screen. I would like to thank the organizers for this opportunity to present a pilot study dealing with large fiscal episodes and sustainable development, some international evidence. And this is a joint project with Yotin Jingarak and Hain Nguyen from Victoria University of Wellington, and also from Tom Park from the Asian Development Bank. And any views are reflecting our views and not necessarily that of the bank. So let me discuss briefly the background. We studied the intertemporal feedbacks between fiscal policy and sustainable development. And the sustainable development is on the agenda of most of the regional global banks. And here we focus on the inclusivity of economic growth and domestic revenue mobilization around large fiscal mobilization episodes. So we aim to study in this pilot project the association between economic structure and the composition of government revenues and expenses, the association between episodes of large fiscal impulses, to be defined shortly, expenses or adjustments, and sustainable development outcomes, including prosperity, inclusivity, resilience, and a bunch of other metrics. And we ask whether past changes in the budget's specific components may lead to or are associated with fiscal expansions and adjustments, which relied on future changes in certain budget items and maybe the tax base. Now, it's a pilot project in the sense that we selected Chile, Poland, South Africa, and Thailand, emerging markets that at the beginning of the project provided sufficient fiscal aggregates and represents a diverse sample set for the pilot analysis. But of course, the weakness of this project is precisely because we have only 4 countries, and this is limiting the power and the ability to conduct a more careful quantile type of assessment. So at this stage, we are done with extending the study, having the data of 72 countries, including most of the interesting emerging economies that we are able to handle. And hopefully within, by the end of this year or the beginning of the next year, we will be able to extend it massively, discussing issues that are more related to the full heterogeneity of the sample. And of course, Chile and South Africa are more commodity-based. Poland and Thailand are emerging markets that are more related to industry and the like. So we detect four interesting observations in terms of overall patterns. Fiscal expansions are associated with higher growth rates and reduced negative trade-offs. For example, the pollution and poor health mortalities associated with higher economic growth. Fiscal adjustments are associated with a more inclusive economy, lowered poverty headcounts, improved sanitations, and cleaner technology access. Fiscal expansions followed an increase in direct taxes, especially the corporate taxes, a decline in social contributions, and preceded a decline in other direct taxes and increase in wage bills. Now, the methodology of the study is following past well-appreciated attempts of LACEA and co-authors and Blanchard to deal with these issues. And the hope is that at least we're having 72 countries, we will be able to say more down the road about these issues. So let me maybe discuss briefly in an illustrative way what we are doing. So first, we define fiscal episodes using the cyclically adjusted change in the primary deficit as a share of the GDP from the previous year. And the dry definition is that we are looking at cyclically adjusted primary deficit to GDP at time t minus the previous period. We correct each of the fiscal variables at period t for the variations induced by cyclical factors. For each country in the sample, we first regress each fiscal variable on its time trend and unemployment rate. Next, we estimate what each fiscal variable would be in period t if the unemployment rate were to remain in the same as in the previous period. And we, to start the analysis, we identify episodes of large fiscal impulses, which may be discretionary fiscal policy, as fiscal stimulus and fiscal adjustment. Strong fiscal stimulus, if fiscal impulse as a fraction of the GDP is larger than 1.5% of the GDP, which is about more than one standard deviation in the sample, and strong fiscal adjustment if fiscal impulse is less than minus 1.5% of the GDP. Now, to illustrate what we have in mind is we are focusing on the sample period that covers, for some countries like Chile, 2000 to 2018, for Poland, 1995 to 2018 and the like. And of course, this sample period is dominated by the global financial crisis and related developments. And within this sample period, we identified 6 episodes of fiscal adjustment and 6 episodes of fiscal stimulus. And the duration of these episodes varies. The longest episode persisted for 2 years, which is the case of Poland, 2008-2009, and fiscal adjustment in South Africa during 2005 and 6. Now, many of fiscal stimulus episodes occurred during the 2007-2008 global financial crisis that, of course, started as a US crisis. And the time path, not surprisingly, of the GDP growth shows associations with the fiscal episodes of stimulus positive and adjustment negative following these quite traumatic events. So let me skip this stage, the discussion of the equations, but it's stated in the paper, and I have in the slides some some of these, but let me focus on the big picture. For our baseline estimation, we conduct fixed effects regressions on the 4 sample countries. First, we examine the association between the GDP growth and large fiscal stimulus adjustment or adjustment changes across the years. And next, we look at the association of development outcomes, including GDP growth and the interaction between GDP growth and fiscal impulses. And we are using it to understand the implications of these fiscal developments on the sustainability goals. And the key outcomes is that fiscal expansions followed an increase in direct taxes, especially corporate taxes, and decline in social contributions, and preceded a decline in other direct taxes and an increase in wage bills. Fiscal expansions were associated with higher growth rates and reduced negative trade-offs. I mentioned before, an example includes pollution and poor health mortalities associated with economic growth. Fiscal adjustments follow a decline in other direct taxes and social contributions, and increase in the wage bills, and preceded a decline in government consumption, expenditure, and transfer. And fiscal adjustment led to more inclusive economy, lower poverty, headcounts, improved sanitations, and cleaner technological access. So I mentioned already that we are fully aware that the sample is too small to claim any robust regularities. So now we are in the process of looking at 72 countries. Now, one should recognize that if we are looking at Chile, Poland, South Africa, and Thailand, there are some country-specific factors. So, for example, Poland, for instance, benefited and is benefiting significantly from EU transfers and the proximity to Germany. And this specific factor, of course, may be of limited relevance for countries like Chile, Thailand, and South Africa. So this is one issue that definitely is resolved by moving to the big sample. And in the big sample, we will control more carefully for the heterogeneity of all the relevant factors in order to draw more generalizable implications. And in this context, an open issue that we are looking now is that once if we are considering larger countries like India, Philippines, Indonesia, and the like, so then there is the issue of the potential tension between the central government, what in the US we are calling the federal government, and the regional states or provincial states. And of course, this applies to Brazil and Argentina and the like. So extending the sample will allow us also to look at some of these aspects in terms of the complex interaction. And at this stage, we are not claiming any ability to generalize what we found in the pilot study, but it's interesting enough that we aim to push it further. So if time will allow, I will draw more on some of the equations and the like, but otherwise we view the results interesting enough to, and hopefully by January, in 2.5 months or 3, we'll have the full study. So thank you very much for your attention.
Thank you, Joshua. You still have a couple more minutes if you want to elaborate a little bit more on.
Sure. So let me maybe return to the screen. So let me point out that in terms of the sample, we are for the definitions of the tax revenue and the like are conventional. We are using 17 sustainable development goals that are stated out here. So they are related to the agenda of the UN, the World Bank. And if you are looking at the way that we are proceeding, so we are following a methodology that we are identifying the fiscal episodes by equations that are summarized by 1 and 2. And the main idea is to look at the trend and the unemployment, and then to use it to project the or to clean it for cyclical developments. And this gives us the ability to identify the impulse structure that is strong fiscal adjustment if fiscal impulse is less than, as I mentioned before, minus 1.5 and above. Now, in this context, of course, this is a choice which is sample specific. And in the extended study, we may revisit it because once that we are extending the study, and for some countries we have much longer period, so then we will visit this aspect, because chances are that in the present sample, it has been dominated by the history of the past 20 years, which may not reflect fully the longer history. So this is an aspect that definitely we should revisit. Now, for our baseline estimation, we conduct fixed effects regressions on the 4 sample countries. So first, we examine the association between the GDP growth and large fiscal stimuli and adjustment changes across years, using equations that are trying to account for the GDP growth and the fiscal episodes related as is accounted by the past fiscal episodes. This is supposed to be minus, not plus, so ignore here. So then we are able to look at the results, and table 1 is focusing on the estimations of the 2 equations, focusing only on the significant variables. And this is the indication of the association between the GDP growth and fiscal stimulus. And not surprisingly, it's significant. But the more interesting aspect of the analysis turn to the next step, which is summarized by equation 6, where here we are looking at sustainable development goals and accounting it for the patterns of growth, fiscal episodes, and then the interaction between these 2 components. And from this, we are able to infer by looking at the outcome of the direct effect and the interactive effect. And we are concluding a bunch of results that I outlined before. So here there are about 4 to 6 regressions that are outlining the main results. So let me skip it. But let me conclude that the observations here are ranging between 60 to 80, depending on the scarcity of data. So again, this is something that we did as a pilot to motivate the more aggressive agenda of the bank of collecting more than 70 countries. And there we will deal with the more complex aspects, especially for larger countries with the federal and periphery or provincial or state interactions. So thank you very much for your attention, and hopefully in several months we'll have the next round, hopefully the final round of this project.
Okay, wonderful. Thank you, Joshua. Very interesting results, especially the link between fiscal adjustment and characteristics of the economy, like inclusivity, right?
Yep.
That clearly is a very interesting result. So in the meantime, let's move on with Guillermo, our next presenters. For those who just joined us, the idea is to do short 15-minute presentations and in the end have a discussion. Guillermo, the floor is yours. You're muted, Guillermo.
Okay, you can hear me now?
Great, awesome, yes, and we can see your presentation.
Okay, very good. Well, thank you very much for the invitation. I'm sorry that Charlie cannot join us. Well, this is a paper that I've done with Andres Velasco. And I can actually summarize the motivation and the results in just a few phrases. And then I will go on to be a little bit more dwell on some of the details. But I mean, the motivation is simply that all of a sudden, there is a new big character going around in international financial crisis, and that's the bond market, the T-bonds, the treasury bonds. They are playing a very large role in the composition and characterization of this crisis. It's a very deep, has a very deep market. It's one of the deepest, one of the deepest markets in this category of assets, and plays a very key role in the financial sector at the global level. But we feel that we have not, the literature has not focused sharply enough on one fact, that it's a liquid asset, and it plays a role, especially in repos in the financial sector. So, as a first approximation, I mean, you can think of the treasury bond as another bond going around, or you can think of it more as a form of money. And it's a very useful money, because the usual cash is not good for collateral, not as good as the treasury bond. So as a first approximation, this is a theory paper. We said, why don't we look at this situation as one when we actually have two monies, right? One of which we call bonds. So suppose it is a console, it doesn't pay interest and so on and so forth, another form of money, and see how far we can go with this, emphasizing the liquidity side. Now, in order to do that, you can put money in the utility function. I find myself, and both of us, Andres and I, more comfortable with the Clower constraint, because you really focus on money as a transactional asset. So that's it. That motivates the model that we use. That's why we have a Clower constraint. So we focus on that, and started to get some results which are quite straightforward once you think about it, but kind of surprising. And in particular, we are concerned when you put things in that framework, all of a sudden you say, well, I have two monies. So what happened with the Fed? Is there a competition between the two? That's immediate, right? It's the first thing you think about. Could there be some interdependence? In particular, what about the dependence of the treasury bond on protection or backstop on the side of the Fed? Because after all, a bond, a T-bond, a treasury bond, the contract of that bond specifies that, I mean, there is a payment that in terms of dollars that, and the Treasury had to get the dollars from somewhere, right? So the backup is the dollars, but the institution that is in charge of printing dollars is the Fed, just to put things in a very simple-minded way. So in a certain sense, and besides, we have seen several episodes from the taper tantrum to March, September 2019 mini crisis to March 2020 crisis, that whenever the stock market started to behave kind of crazily, the Fed came forward. A couple of situations when the Fed started to talk about tapering, and something became, and the Treasury market became kind of more volatile. The Fed was immediately came forward with a policy that sort of stabilized. So there is an interdependence that we haven't seen so much in the past. Okay, so that's the reason that motivated us to focus on those issues. And the model is extremely simple. You couldn't imagine a simpler model for that. So let me go now, hopefully, quickly over the presentation that I have prepared. Okay. So the focus will be on a situation where this is a global model, so it's a closed economy model. It's where, to simplify, of course, you have the dollar and Treasury bonds. And first observation is that the Treasury bonds, in one way or another, started to play a much bigger role than they used to in the past during the great financial crisis, when, as a first approximation, Treasury bonds supply expanded big way as a result of fiscal deficit, right? But the crisis itself is a situation where liquidity is at the forefront, right? Liquidity here is just one of many pieces of evidence that are available to show how big the destruction of safe assets was at the beginning of the great financial crisis. And according to this, is a fall of 15% in the value of safe assets, momentarily at least, as a share of world GDP. This is an enormous, totally unexpected shock, as everybody knows. And that was followed by an expansion of US federal debt, big way, and an attempt to increase safe assets in exchange for toxic assets. Toxic assets are the ones that kind of crashed during the crisis, and by open market operations or things like that, safe assets were pumped into the system in order to compensate for that big liquidity. Liquidity is always in our screens, so to say. So this is what concerns us, the destruction. And as a result of this and other policies, you see that US federal debt doubled. That's an enormous amount of money. And not only that, and this is very, very, very interesting, that the US, that the Fed played a big role in absorbing that debt. Actually, the debt held in the Federal Reserve banks quadrupled. So if you saw that in an emerging market, you would say immediately, oh, what about central bank independence? This is fiscal domination, fiscal dominance, as we call it, right? Well, I don't think that that's the case, but that's what you see when you look at the numbers. You see federal debt, you see, as a share of GDP. And this is the beginning of the global financial crisis, then jumping big way, and then jumping again since at the beginning of the pandemic. I realized that I already spent 10 minutes of my time. And also here you see that the Fed's debt holdings that used to be less than 4% of the total debt, public debt, federal debt in the US, went from that to a number around 25%. So that's why I'm saying if you saw this in an emerging market, you would conclude immediately that there is some kind of fiscal dominance. We don't think it is fiscal dominance according to our model. It's an issue of financial stability. During this time, besides, you see the yields collapsed, which is equivalent to saying that the price of federal debt increased. So in the midst of all of that, big expansion of federal debt, instead of having prices falling, you have prices rising. So it's a clear indication that there is some kind of liquidity crunch here that was partially filled by the expansion of treasury bonds, but maybe it was not enough. And that's actually my feeling, that the fact that the dissatisfaction that we have had about the effectiveness for growth, not the short-run effectiveness in order to prevent another great contraction, but the fact that growth was very weak afterwards could be related to the fact that there was not enough liquidity put forward. But that's a different issue. So
you have a little less than 5 minutes.
I have 5 minutes, okay. Let me show you the model. So you realize that you can capture some of these things in a model that has two forms of liquidity, the usual money and T-bond, which is in our model is a console, just to simplify. Here is the amount of T-bonds, and Q is the price of the T-bond. And the Clower constraint, liquidity is equal to output, okay? And then you have the usual new Keynesian model with carbon prices. So the only thing is just to focus, increase this element. That helps you think about how this could work. So join at the hip, that's the key of our presentation. It immediately comes to mind in the fact that now you have two forms of money, and so there's an issue that who is the one who is providing liquidity to the market, and how does that work? So already you see that now there are two players there, and there's a lot of economics that can be discussed. Some of that is in this paper and other papers that I'm writing presently. The second thing that I mentioned, that T-bonds are implicitly collateralized by central bank money. And I already spoke about the fiscal dominance, so let me skip that. Now, if you work in terms of the model, you look at the steady state in this model, then by first order conditions, you hold the two monies as a function of the opportunity cost. When you do the standard analysis, you realize that there is a connection between the stock of money and the value of T-bonds. So what happens here is that if T-bonds supply increases and you do nothing with money, the price, and you are at the steady state, the price of those bonds fall. So that may not have any effect. The fiscal policy, which is just based on transfers, may not have any aggregate effect, number one. More interesting, and if you think through it, it becomes obvious. If instead of the stock of T-bonds to increase now, if people expect that they will increase in the future, then of course in the future Q will fall again. But since you have rational expectation, it will start falling now. And when that happens, since still the stock of bonds have not changed, the liquidity that you get from the bonds falls and you have a depression. So that's again a surprising effect that all of a sudden this expansion may give rise to a depression. And if you want to compensate for that, you have to increase money supply. So here you see the possible interaction where simply announcing that, or people expecting that the supply of bonds will increase big way, in the short run, it could be contractionary, and it may motivate the central bank to increase money supplies, which is what you saw empirically. So I'm not saying this explains everything, but this is just to show you how simple but interesting at the same time results you can get from this kind of analysis. So here is simply showing how this would develop. I'm just getting very close to the end, Andres, don't worry. So this kind of situation where there's an anticipation of future increases in treasuries, which is what, I mean, we are talking about these days in the US, right? Whether there's gonna be an expansion of fiscal deficits in the future. In the short run, could very well lead to a recession, and then eventually, when the treasuries increase, as you move in that direction, output will start recovering. You can, a casual observer may think that it is the expansion of treasuries that is causing the recovery. Actually, the recovery happens because there was a recession to begin with. So there are some interesting exercises, the same thing about inflation and so on. So when now in terms of this model, you say, well, if the government wants to avoid the recession, then the optimal policy is to increase money supply. So you see the Fed reacting in response to the Fed policy, and it looks like fiscal expansion, the fiscal dominance, but actually is simply a result of the dynamics of the model. So this is a very brief conclusion. The treasuries are backed up by the Fed, and there is a connection there. The Fed could very well stop doing anything if there is a taper tantrum, for example, but if that kind of policy can bring about financial problems because of the repos in the financial market. So there is a dependence. The connection will be hard to break, especially now that treasuries are very close to 100% of GDP. There are many issues here. So that's why the incentives of the central bank to support the treasury for financial reasons. So it's not necessarily because of fiscal reasons. So I spoke about this. So I guess I cover the main points that I have to show you. And thank you very much for your attention.
Wonderful, Guillermo. Thank you very much. As always, very, very insightful. You help us keep liquidity issues always in our radar. This time linking it to T-bonds and how that generates an instant connection with what the Fed should do in periods of financial distress. Let's move on with Klaus. Klaus, can you share your screen?
There you are. I hope you are. Can you hear me?
Yeah.
Excellent. Let me also please double check, Andres, if you can see now my screen, full screen.
Perfect.
Thank you very much. Well, it's a pleasure to be here and to joining you for this very short presentation and short special session. And my thanks go to you, Andres, to the colleagues who are presenting very interesting work, and to Charlie, obviously. This paper, which got financial support from the CAF in Caracas, it's about fiscal policy and rules in Chile, Colombia, and Peru. The question which was put forward by CAF to me was, what's about the current fiscal frameworks and their developments over the last, let's say, 10 years or so, or a bit more in some cases? And in particular, what about the fiscal rules? Have they worked? Have they not worked? Have they met their counter-cyclical objective? So my paper is, I briefly motivated it subsequently. I will speak about institutional frameworks in a graphic timeline sense. I have no time to do a complete narrative of the development. Then I will present my main hypothesis, the data estimation techniques about the main questions and issues I want to address, briefly the results, and reform proposals, how to improve the fiscal frameworks and the fiscal rules in those three countries. Given the fact that a developed fiscal framework is based on different institutions that contribute to fiscal and macro performance, of which fiscal rules are one major building block, I review the Chilean, the Colombian, and the Peruvian experience, which I think is very timely and enlightening today because of the consequences of the very expansionary fiscal policies in most countries, and including these three countries during the coronavirus pandemic. Therefore, I focus on three things. Number one, how fiscal frameworks have evolved over the last years, and where do they stand today? Second, I want to test, particularly if the main fiscal variables are cyclical, acyclical, counter-cyclical, pro-cyclical, after adoption of fiscal rules in these three countries. And finally, I make some policy proposals for improving the current fiscal frameworks in the three countries. The institutional framework, I promise you a timeline. Here it is. In red, the laws. In lilac or dark violet, certain institutions, that advisory fiscal councils or independent fiscal council in Chile. Then the rules in green, in light green, the advisory committees. And this is a timeline which started in the 80s and ended in 2019 in the case of Chile with the adoption by law of an independent fiscal council. Similar things I do for Colombia. I have no time to go over the details, but the logic is exactly the same. And for Peru, maybe this is just one word I want to talk about Peru. Peru has lots of laws about fiscal prudence, fiscal responsibility, laws to strengthen fiscal responsibility, and so on and so forth. It also has had a lot and different, its experience is very rich, maybe too rich, in terms of different fiscal rules. It had an exchange rule, budget balance rule in 1999. It had a debt and a cyclically adjusted balance rule in 2013, and in 2019 it put in place another rule, which is basically a budget balance rule again. Let me go to the main hypothesis. I test fundamentally 4 hypotheses. Number one, I want to first measure if the quantitative target for the fiscal rule depends or does not depend on cyclical conditions. In other words, if you have very favorable fiscal conditions, get the targets, are the targets changed by the fiscal authority to make it more ambitious or less ambitious? The second hypothesis, and the third and the fourth, is about the cyclical behavior pro-cyclical, counter-cyclical, after the start of the rules of public expenditure, of public investment, and of debt. So we are looking at the cyclical behavior here of those three fiscal outcome variables, but which are under the control, at least to a large extent, of the policymaker. Here's the data, the sources. I will not bore you to death about those details. They're on the paper. And what we do is basically work. What I do is work with pretty conventional estimation techniques. I do econometric regressions. First, three-stage multinomial logit regression for the value of the target. For instance, if the cyclical adjusted balance is 0% of GDP, or 1%, or 2%, minus or minus 3%, as it has changed in some of these countries over time. And then I do econometric estimations about the outcome variables, so the fiscal variables, which are basically, again, total public expenditure, total public investment, and the public debt. Two flow variables, one stock variable. And finally, I do, in order to double check on my econometric estimations, I do VAR estimations for the previous four variables to try to check with a very different technique if I get more or less consistent results. And yes, anticipating my results, which I will not present here, but they are in the paper, what I get from the econometrics is more or less pretty much consistent with what I get from my VAR analysis. Let me now briefly summarize just in one page the main results. There are lots of figures and tables in my paper. In a summarized way, they are here. Number one, on hypothesis one, which is responding to the question if the quantitative target for the fiscal rule, which changes over time in these countries, if it changes with the cyclical conditions. And the cyclical conditions I measure in two ways. Number one, the main commodity price, which in Chile and Peru is the copper price, and in Colombia is the oil price. And number two, with the output gap. And what I find here in the case of Chile is that a positive shock in copper price increases the value of the target. So the fiscal authority gets more ambitious if the copper price increases. This is in the case of Chile. For the output gap, I do not find anything. And when I do not say anything about a specific variable, either the commodity price or the output gap, is because I do not find a statistically significant result. In the case of Peru, I do not find any result. In other words, the target values are independent of cycles in Peru's commodity price, main commodity price, which is copper 2, and in Peru's output gap. Regarding hypothesis 2 and 3, number 2 is related to hypotheses regarding total expenditure. In Chile, there is significant evidence that fiscal expenditure and also public investment act in a counter-cyclical manner, or reflect in a counter-cyclical manner what happens with the output cycle and what happens with the copper price cycle. If there is a positive shock in copper prices or in the output gap, then expenditure tends to fall and investment also tends to fall. In the case of Colombia, Colombia reacts positively in the sense that when there is a positive oil price shock, Colombia's expenditure investment are adjusted downwards. In Peru, we do not find much evidence at all, neither regarding the government expenditure nor public investment. In other words, the different fiscal rules which Peru has had up to now have not led to a statistically significant counter-cyclical policy, fiscal policy measured either by expenditure or investment. Regarding the debt, which is hypothesis 4, we basically confirm results which are consistent with the results I just reported on the flow variables under hypothesis 2 and 3. Reform proposals, very briefly, and that's my last presentation, my last slide. In the case of Chile, Chile has now in place and has had for 20 years in place a budget balance rule based on a cyclically adjusted balance. And certainly what is missing Chile is a complementary debt rules. Why? Because if you do not have an anchor for fiscal policy more consistent with the permanent income hypothesis, and the anchor has to be outstanding wealth or financial wealth, in this case, net debt, then you may have a very significant drift in your fiscal position. And that's exactly what is happening in Chile over the last 10 years, probably. It's drifting toward higher deficits and higher levels of debt. And this drift has simply exploded during this current year, 2021. So urgently, Chile requires a complementary debt rule in complement to the existing BBR rule based on a cyclically adjusted balance. Also, in Chile, we do not have escape clauses, and there's no clear treatment of public investment to isolate public investment from the cycle. So it would be very useful to have both escape clauses and separate treatment of public investment. And finally, the Independent Fiscal Council, which was something very positive, which was put into law 3 years ago or 2.5 years ago, lacks a little bit more of capacity, legal capacity to do more things in terms of overseeing, in terms of the very few resources which they have in order to do deeper work, and it lacks also teeth regarding their recommendations. In Colombia, we recommend something very similar. Colombia has also in place, thanks in part to Andres Velasco, actually, Guillermo, you might remember that Andres was advising the Colombian government some 10 years ago, and they put in place a rule which is very similar to the Chilean. And for the same reason as in Chile, I would also recommend a debt rule in complement to the balanced budget, to the budget balance rule. In Colombia, there's not much of counter-cyclicality of fiscal policy. I would certainly strengthen that, and also strengthen the Independent Fiscal Council, and also improve the management of the sovereign wealth fund. In Peru, there's only a debt rule at this place. So in this case, I would recommend, in analogy to what I recommend for Chile and Colombia, that they should put in place a complementary budget balance rule based on a cyclical adjustment budget. Peru, as I mentioned before, had many changes in the rules themselves and in their parameters and the target values. And this should be avoided in the future, hopefully. They should stick to one rule or two rules, complementary rules, for a longer time, let's say 10 years or so, and strengthen at the same time the Independent Fiscal Council. And that, I would say, are the main recommendations which come out both from our empirical analysis, and from my narrative of how the fiscal institutions work in these 3 countries. Thank you very much for your attention, and I'm happy to address any questions which could come up at the end.
Klaus, thank you so much. Right on time. Let me now share my screen, and we'll move on to the very last presentation. Again, this presentation was supposed to be done by Charlie, but unfortunately he cannot be with us today due to some minor health issues. So this is a paper joint also with not only Carlos, but Rui Lama and Daniel Guzman. The paper is mostly a theoretical paper where the motivation is pretty well known, I'm sure, in this audience. And it's the fact that in the developing world, fiscal policy has been traditionally pro-cyclical. Now, this is a well-known fact. mostly for government expenditure. This is a plot that Charlie, together with Carmen and Graciela, several years ago, popularized, that showed how in the overwhelming majority of emerging markets or developing economies in yellow, the covariance, the correlation between public expenditure and real GDP, both in cyclical terms, is positive, right? So you have a procyclicality in government expenditure, unlike in most of the advanced economies in Black, where government spending is counter-cyclical. This is very well known. This led to the well-known sentence of "when it rains, it pours," right? Now, perhaps less well known is the fact that the same plot, which Charlie likes to call them the Peñarol plot, because of his beloved team. So there's also a Peñarol plot, one of these plots for taxes. Not tax income, but tax rates. So the alternative tool of fiscal policy, where most of the, if not all, most of the emerging markets tend to be pro-cyclical also in taxes. So in bad times, they tend to raise tax rates, as opposed to mostly an acyclicality in developed economies. So why? This is the question that the paper tries to address. It is an old question in international finance and in public finance. I would say there are two main explanations or two strands of the literature that have tried to answer this question. One well-known strand is one that alludes to political economy factors, to which this paper is gonna add nothing. But the second strand of literature that has pushed for the idea of imperfections in international capital markets or financial frictions, that's where this paper aims at contributing. Now, if you read the literature on the subject, on the second strand of literature, most, if not all, the explanations have evolved around the presence of two types of very distinct financial frictions or financial distortions. The presence of sovereign default risk and the presence of limited commitment from the part of the government. Now, they might be all true, these two dimensions. They might be plausible explanations, but we think there's still a much simpler question that remains to be answered in this second strand of literature, which is, are incomplete asset markets, which is the simplest, the most quintessential friction that we write down the moment we write the first small open economy model, are incomplete asset markets sufficient to generate the procyclicality in fiscal policy in both instruments, government spending as well as tax rates? If the answer to that question is no, they are not sufficient, then one would be inclined in thinking about more elaborate and more sophisticated distortions, such as the one I mentioned earlier. So how do we answer this question? Well, we're gonna answer it in the most simple framework. We're gonna write down the simplest toy model that you can think about of a small open economy. It's gonna be a static model, and fiscal policy is gonna be set optimally a la Ramsey with uncertainty. What is nice about this is that the intuition from this very simple static framework follows to a more richer environment within a DSG model. So I'm gonna mostly spend my time on the static model. And and more importantly, the evidence is supported with some empirical analysis that the paper presents. I'm not going to have the time to go over. So let's talk about the static framework. Again, we're not going to innovate much on preferences. We're going to follow Baxter King that postulated that households derive utility from private consumption, CI here, and GI, which is public consumption, right? And importantly, preference parameters, in this case, sigma C's and sigma G, are gonna determine the extent to which consumers, households, are willing to forego private and or public consumption intertemporally. Now, in a static framework, we're gonna have two states, just two states, H and L, high and low. And keep in mind that if you hold, for example, constant sigma C at 1, you're in the intermediate case, the one in the middle, then sigma G, the lower the value of sigma G, the less willing consumers are going to be to substitute government consumption for private consumption. This is going to be important in the model. So what does, let me just throw out the results from the static model without going into much math. So first, under complete markets, once you do the Ramsey solution, both government spending and tax rates, the two instruments of fiscal policy, are going to be acyclical. They're not going to move whether you are in H or in L. So they are the same across states of nature. That, I guess, is kind of intuitive from basically the presence of complete markets, right? You're going to smooth consumption the most. What happens under incomplete markets, which is where the paper tries to contribute? Well, government spending, we show, is going to be always procyclical. So yes, incomplete markets are going to be a sufficient condition for generating procyclicality in government spending. But the same cannot be true, is not always true, for tax rates. The cyclicality of this instrument, tax rates, will depend, however, on the relative values of these preference parameters, sigma C and sigma G. You could have countercyclicality, where theta H and theta L, which the ratio we call theta tau. You can have theta tau being countercyclical, so taxes in the high state of nature are higher than in the low state of nature. If sigma C is less than sigma G, they can be acyclical, so the two remain the same, if the two preference parameters are the same. And importantly, you can have also procyclicality in tax rates, so theta H lowering with respect to theta L, if the sigma G is lower than sigma C. We call this the preference parameter, the consumption preference channel. Importantly, another thing that we prove in the paper is that tax rates are going to be procyclical if and only if the ratio of C to G commoves positively with the business cycle, and the data validates this condition. So we're in the third category here of procyclicality. What is the intuition here? And this is the gist of the paper. Say you have a boom triggered by, say, a positive productivity shock. You're going to have C, consumption, private consumption, booming relatively more than G. This ratio is going to go up. The tax base, hence, is going to go down, is going to go up, sorry. And the need to tax that tax base, so the tax rate, can go down. So you're going to have a booming economy with consumption booming more than public consumption, and tax rates going down. That is the empirical case that is validated by the data. The intuition that I just conveyed in the form of the consumption preference channel follows entirely a richer structure in a DSG where, importantly, a second channel comes in, which is the consumption smoothing channel, which tends to offset the first channel. Why? Because consumers now have the possibility of issuing debt to absorb the effects of the shocks, right? So, so these two channels try to offset each other. However, we find that for the main calibration, the consumption preference channel prevails. This is a set of results that illustrate the functioning, the mechanics of the DSG model and how they map very well to the intuition from the static model. On the upper panel, you have the correlation between government consumption and income in the model. And on the horizontal axis, you have here the sigma G, right, the preference parameter. Now, as in the static model, as I said, regardless of the value of sigma G of preferences, you're going to have procyclicality between government expenditure and output, right? So these correlations are quite high. Here, the differences in the lines come from differences in the degree of financial frictions embedded in the elastic interest rate parameter. So the higher this interest rate elasticity parameter, the harder it is for consumers to issue debt in bad times, the more financial frictions there are. But regardless of how much strength there is in this distortion, you are always going to have procyclicality in government expenditure. The same cannot be, the same is not true for the second instrument. And here I'm referring to the lower panel, where we're plotting the correlation between the tax rate, tau, and output. And as you see, there's a region here where the tax policy can be either counter-cyclical or pro-cyclical. So there's a region where this correlation can be positive or negative. Now, for plausible levels of financial frictions calibrated to the data, you get very similar results from the static model, which is values close to 1 for sigma G will deliver negative correlation between tax policy and the cycle. So procyclicality in tax policy akin to what we observe in the data. Now let me show you the last set of results, which we believe are novel in this literature, insofar as we compute welfare costs associated to the procyclicality of these policies. In the first panel to the left, we have the correlation of the first instrument, government expenditure with respect to output. And here, again, this parameter psi captures the strength of financial frictions. So as financial frictions are stronger, more prevalent, you get a higher level of procyclicality in government expenditure. You get the same for the second instrument, the tau, the tax rate. Now, what happens if we do welfare analysis? So what if we compute the welfare cost associated to business cycles under different values of this level of financial frictions? So what you find is that as you increase the level of financial frictions, you will increase the welfare costs associated to business cycles. And the channel operates mainly through the procyclicality of government policies induced by higher levels of financial frictions. If you calibrate this to emerging markets on one hand and advanced economies on the other, you will get an increase in the welfare cost associated to business cycles of about 1 to 2 between advanced economies and emerging markets, meaning that the welfare cost associated to business cycles in emerging markets are in the neighborhood of twice what you have for the calibration with advanced economies. So quite relevant implications for welfare of the procyclicality in fiscal policies induced by the presence of higher financial frictions. So let me conclude by saying the following. There is abundant evidence by now that when it rains, it pours, as Charlie, Carmen, and Graciela popularized. That conclusion prevails not only for government expenditure, but also for tax rates. We have shown that incomplete markets are sufficient to generate procyclicality on the spending side, but not on the taxation side. However, tax rates are procyclical if and only if the ratio of consumption to government expenditure moves positively along the business cycle, as the data indicates, which we show in the data. And just to tie the discussion to the very nice presentations before, the obvious policy implication follows, given that fiscal procyclicality is costly, how to avoid. And the fiscal rules, such as the ones that Klaus presented, are the obvious first tool in the toolkit. Thank you very much. So why don't we, since I see the room is still with audience, why don't we take a few minutes for questions if there are from the audience, but obviously welcome any reaction from the panelists. I do see that Klaus has raised his hand.
Thank you, Andres. Most interesting your presentations. I have one question for Guillermo's and one for Andres's. Guillermo, if you had not chosen the Clower constraint, where you have a one-to-one relationship between liquidity and therefore the supply of debt and or money and GDP, but if you had money and utility, say, would the results be very different or just qualitatively different, less intense, in other words? And the second question for Guillermo is, if both your liquidity variable, money and bonds, play in a sense a different role, not as a Clower constraint, not as money or bonds or liquidity and utility, but as the asset of last resource to which markets, people, investors tend to hoard whenever they are struck by panic. Let's say September 2008, or the smaller events of the conundrum, or 2018, 2019, which you listed, or the strong events of March, April during the pandemic. If that were the role of money and bonds, reassuring markets and giving people an opportunity to diversify away towards safe assets, would the results be very different in terms of the recession and the expansion implications which you draw from your Clower constraint-based model? And for Andres, a very brief question. I don't know, because I have not seen in detail your DSGE model and your most interesting work with your co-authors, but is there a feedback effect from the tax rate to activity because of distortions of taxes? So is that considered as part of your ambiguous pro-cyclical or counter-cyclical role of taxes as opposed to government expenditure, which goes immediately and directly into consumers' utility? That's it.
Okay, can I answer now, Andres?
Yes, please, Guillermo, go ahead.
Okay, very good questions, Klaus. In the first place, what I think what we have done is to state the obvious on paper. You say, well, there are too many, let me see how this works. When we started, we realized that there was a close relationship between this kind of model and the ones that we developed many years ago, particularly one paper with Charlie on currency substitution. So it's an example of currency substitution, and it's interesting to think about that because in currency substitution, you have domestic money and dollars, say, right? But the dollars is like the treasury bonds.
Exactly.
In the present model, right? So there is a difference because you don't control the supply of dollars, etc. So that's an interesting comparison to make and maybe learn something deeper on how, depending on how the two monies interact. That's one very substantive question that you ask about how does it work in the system? Because you're right. We put two monies there and then we go on with standard analysis, right? But if we are more serious, we really think of how the thing works in the financial market, then it's not obvious that money that is used for, say, daily transactions, consumer transaction, is going to be something that, parallel to. So there is I see this as a first attempt that has to be enriched by the kind of considerations that you brought about. I have done something now, and I can share with you papers that I'm writing along those lines. In the first place, just to show you how things can get really crazy. When you put another money, if you think a little bit about it, you start thinking, hey, wait, is the sticky prices sticking?
Mm-hmm.
Because true, with the standard money, you have a problem that you cannot bypass to get to. But if you have
Right.
another money, could there be a full employment solution? The answer is yes. And I have a little note showing that. So it really, it kind of opens up a world that we have, my feeling is, explored enough. Now, but certainly, from a formal point of view, my co-author Andres, he has an answer to your question about utility functions. I have not worked out the example, but he tells me that if you put some restrictions on the utility function, you get the same results.
Okay.
But not for everyone. I will ask Andres to elaborate and maybe send us a little note about it. Thank you very much for a very good question. I find it, that's what I like about this paper mostly, not the answers that we get, but the questions that it raises.
Right. Thank you, Guillermo.
You're welcome.
Klaus, on your question, very briefly, so just to be sure I'm understanding, when you mention the presence of further feedback, there is distortionary taxation. We have taxation on consumption, right? It is very simple. So basically, government taxes consumption. But I don't know if you're thinking about more feedback than that. If you are, we don't have any more feedback than that. That's basically, there is some work that we're doing in terms of how much results are robust if you tax labor, right? That's something that we are exploring right now.
A double-handed, yes. When you had, for instance, a distortionary taxation on labor, and much more distortionary taxation on production and investment, and your tax cuts or tax rises were temporary, you might induce a very strong investment and production response of investment being postponed to the future, or a huge investment boom if you lower taxes for a temporary period. I was thinking about that.
Absolutely, I agree. Conceptually, I agree. We don't have capital in the model.
I see.
As of now, probably we will have to add it at some point because of these sort of questions that have also raised before. But the intuition, I fully agree with. Great. Are there any more reactions from the panelists? I have a few, but in case Joshua, Guillermo would like to react.
I didn't get you. React to what?
React to all the other presentations before we open the floor to the audience.
No, I mean, I have questions, but I better read the paper in details and send the questions to the speakers. Very interesting, the whole thing.
Yeah, I also prefer to read before asking. Yeah.
I guess I'm too anxious to read. Let me ask a question to Klaus. So you raised the issue of escape clauses, right? And the need to have them. What would be your suggestion to make sure that countries use these escape clauses and do not abuse them?
Yes,
which is always the rules versus discretion debate. And then on the issue of Colombia in particular, it's interesting that you bring the anecdote that it was Andres who helped us design the rule. It was meant to be a rule pretty similar, if not identical, to the Chilean, and yet you come to the conclusion, as many others have, that the rule in Colombia has not been as countercyclical as it could have been. And you raised a very important point, I underscore it, of the need for clarity in methods and parameters, right? Would it be possible for you to elaborate on that a little bit more, Klaus, and how to get there?
It's very tricky with a Colombian to elaborate in lots of details. I think it was very hard for me and for my assistant to get the data and the changes in parameters and values. There is not much documentation on that, and there seem to be changes over time. So I did this assertion, but I hesitate to elaborate much because I do not very much know the details. Regarding escape clause, you're absolutely right, Andres. It's very easy that a country, if the escape clause is defined too widely or too broadly, that the country may be tempted every year or every second year to use the escape clause to deviate from the rule. But at least in the case of Chile, which is the case I know better, given the total lack of any formal escape clause, many different governments escape them very often, and in a very discretionary ad hoc way. Andres Velasco did it in January 2009. The current government is probably a record holder in deviating from its own pre-established fiscal objectives a year ago. During this year, where Chile records the highest growth rate in probably its recent economic history of the last 3-4 decades, 11%, we will grow this year, as you know better than me, because you work at the data generating and data using factory at the heart of economic policy making, Andres. So in Chile. So I do not like that situation. I think there should be some bounds put upon the policymaker. And so, for instance, what Peru has done, and well done, is defining an escape clause conditions whenever there is a recession which is larger or deeper than X%, whenever there is a revenue shortfall, unexpected revenue shortfall of so many percentage points of GDP coming from lower copper prices, then you may adjust your fiscal target, or you may deviate from the fiscal target which you pre-established 6 or 12 months before by certain percentage points. Now, it may still be the case that given that escape clause, the government may escape from the escape clause and made it much deeper, the adjustment, if such conditions arise. But at least on paper, you have the option of invoking the escape clause and hopefully manage your fiscal policy within the boundaries established by the escape clause, which I think gives you more institutional stability and policy-making stability, in this case in Peru, than when you lack them like you do, for instance, in Chile.
Okay. Thank you, Klaus. Let me open the floor in case there are questions, reactions from the audience. Okay. Well, let me close now the session by thanking you all. Klaus, Joshua, Guillermo, thank you so much for making the session a success, and hope to see you soon in person.
Okay,
Thank you.
see you. Thank
All
you.
the best.
All the
Bye.
best for all of you.
Bye.
Indeed.
Ciao.
It was much fun. Bye-bye.
Bye.
Bye.